Right, and welcome back to our second session of tonight's mergers and acquisitions question. We are working on question 45 from the kit and just waiting for people to jump back into the room. And or while we are waiting, we will pick up again from where I was just saying, what is the profits of TICO? So profits of TICO were given up in the income statement extracts up here, and profits pre-tax was 23 million. So using that 23 million down here, after tax, to find PAT of TICO equals 23 million times 0.8, 18.4. Thanks, Stacy. 22 million times 0.80 equals $18.4 million. That's two decimal places. 23 times 0.8. Yeah, 18.40. Good. So if that's the PAT, which is equal again to E in the PE ratio, then for TICO, P over E times the E will leave us with the P. I think I've said that before, but just indicating exactly what we're doing now. We have the 11.26 times the 18.4, and that will get you total price, total company value of 207.18. Of course, that's now value in millions of dollars. So this is what I'll scroll across to this column here, where we had the value of V and now the value of T. 207.18, right? So that again, total value of TICO before the acquisition. So this will give us total value of both companies before the acquisition. Add that up, somebody. 1347.18. Good. So summing is the values. There we go. 104.747.18. So again, putting that in a little total sign. Right, of course, that's a value, as we mentioned, up above dollars, millions. Right, now the real work begins. We now need to value all of the long story that the question gave us now to get the value after the acquisition. So this will now compare to value of, or value created, or I can say value of combined, value of entity, or entities plural, because we have sell-off and all sorts of things going on after the acquisition. TION, acquisition. Right, so now we could run through the notes probably one at a time, and even any of the other bits of workings that you could have done before that we didn't do, we'll do the workings as we need it. So starting off one at a time, what can we do for these current values? I mean, sorry, combined values. Again, Let us start from the bottom and see if we could pick off any easy items first. Starting with note 8. What does that tell you about the value after? Okay, this is the mic on this computer. Hold on, I need to I pulled out the headset then. I'm gonna plug the headset back in now. Hold on. Right, is that back on yet? Testing, testing, testing. Can we hear now? Yeah, it seems to be good now. So I have a little mic indicator that tells me when my mic is transmitting. So it should be okay now. Right. But I was saying, that's probably when I leaned over the why I got a bit slack. Yeah, we were told that 7 million, somebody called it synergy. Who was saying that up here in the chat? Let me scroll up. That was Amara calling it synergy from note 8. Right. Yeah, estimated the combined company annual after-tax earnings will increase by 7 million due to the synergy benefits resulting from Vogel and Department A. So we can start off adding the easy stuff, people. Adding the easy stuff. So synergy. And by having written this down on your paper, you're collecting some marks, people. Collecting marks, 7 million. And again, as we have decided to work with 2 decimals, I could pull this whole column down and keep it in 2 decimals, right? So millions, dollars, millions. Right, so we have money from synergy to tally the total value after. Right, still trying to roll up from the last note, come forward. We have after the acquisition, when Department becomes part of Vocal, it's estimated that the PE will increase by 15%. How will that help us? If we have this new PE, what could we do with it? So this new PE will have to be able to I'm noticing they use my 7 in a little different way. They use the 7 there to add on to what? Estimated the company's after-tax earnings. So this 7 is not just the company value. So hold on. I have that 7 in the wrong column. That 7 is not the value of the synergy. If it was the value of the synergy itself, Amar, then we would have added it in there, right? But as of now, it's a value that's being generated from, right, due to the synergy benefits, right? So it's not the value of the synergy benefits, but what is it? It is a increase in after-tax earnings. So this is just a bit of the earnings, all right? So I cannot put that into the last column, right? So when we look at earnings, and that directly relates now, note 8 to note 7, in terms if we find a new PE, right? We could take again the PE times the new level of E, which has gone up by the 7, and that will get us once more to the price or to the company value after the acquisition. So let's go back and edit what we're doing with that 7. So we're looking at that in a sub column here to be only the level of earnings. Synergy, not synergy itself, but synergy extra earnings. So that's piece of earnings, again, in millions of dollars. I could just copy that, right? So that's not value yet. That's extra earnings. So what's the rest of the earnings? Do we have any other idea of where the earnings is going to come from? So what other earnings will we get? Let's keep looking. So we're doing an earnings working to find value, or to find E. And then, hold on, before we stray too much further, Kanisa had mentioned to us here that this increase pre-acquisition value V126, right? So that's some of the pre-acquisition earnings. Sale of assets, hold on, we're going to get to sale of assets just now. Would sale of assets increase your earnings, right? Remember, earnings is your regular turnover. So I will have to double check that sale of assets. And I'm coming to the 126.56 shortly. But before that, or before I leave note 7, I'm going to find the PE that we can use, right? So kind of trying to finish off the usage of the notes as we go along as well. So we have the extra earnings. We will say the PE after of V co would be equal to, what was our PE above? 9.01. Why did I type CCO up here? That's VCO. Right, so 9.01 going up by 15% now. 9.01 times 1.15, and we have the PE being equal to, come on, what's the new PE? Right, 10.36. So when we get that, I know it's sort of messing up the working here. We're doing the earnings, but when we do get the total earnings, we'll come back and multiply by that. Right, the next point, earnings, as Ceci said, current level of earnings. Earnings before acquisition of FICO was that 126.56. Right, so that's taken from above, up here. And what else has happened to our earnings? Let's go reading. So Kanisa mentioned sale of assets, 10% depreciation. Assume that something. All right, so we ain't dealing with note 6 yet. Cost of capital 10%, first year operation will grow by 20%, then 5.2. That's in edge business. That's something else that we'll have to add on. At present, 10% of B's PBIT comes from sales made to C. If we're looking at this combined entity for now, the VCO after, don't think that'll affect V. Secured bond by purchased by Inedge, taken over by Inedge, fuzz rains. We'll pay up these things. Realizable value, so on and so forth. None of that helped us with the earnings. What else is happening to our earnings? Excuse me. Okay, I think I passed it. Upon acquisition, Department A will become part of Vog. So that's right. That will now increase our earnings, right? So we will earn what Department A can earn. So I have to come back here and look for my share of P, B, D, T, as well as pre-tax profit. Good. So Department A, which is being kept 50% times T goes pre-tax profit P, B, T, right? So will be added on to A, to V, right? So let's go over here and note that. So this here, if I put a little subheading, this could be value of V plus A, right? So we're added on to A, and earnings of A co equals 50% times, what was the earnings of TCO? Did we have that up above somewhere? $18.4, right? So up here somewhere. Right, here it is, profit after tax of T, right? So this here now would be equal to half of 18. $18.4 million, and that gets us 9.2. Right. So if all of this is your earnings, anything else affects our earnings? No, I think that's about it. Add that up. Value of VNA. 142.76. Any queries here? And now we're going to multiply by this 10.36 that we mentioned earlier. So I just worked it in the note. I could have brought it back down here. I would have probably been a little better structure down there, but already wrote it in. Thus, P is equal to the P E times E. In other words, value of V and A equals 10.36 times 142.76 million dollars. What's that gonna get us? Yes, no? People getting values like that? Something close to that? Right. So we have just begun. So we started with the underneath. We started with V, and we realized we had to add on A. So we went up and we found that. So we dealt with node 8, node 7, and now we need to deal with the other things that result after. Don't forget, we also have to value everything else because we want total value after to compare with total value before. So we finished node 7 and node 8. Tax rate applicable to all companies, we have that. NEDG can claim this 10% tax allowable depreciation on its non-current assets. Look at this node 6. It can be assumed that the amount of tax allowable depreciation is the same as the investment needed to maintain NEDG's operations. So remember, if we deal with profit after depreciation and we're trying to get the cash flows, which is what we are doing, depending on the valuation method, that is, we would not adjust because of this node 6, right? But remember, Anita, that will only be a no adjustment if we are starting with the profit after depreciation. So we'll have to go up and check what profits are we dealing with NEDG. So let's continue reading. NEDG cost of capital is 10, estimated first year. Free cash flows. So the one free cash flows will grow by 10% and then 5.2 annually thereafter. So once you read this note 5 and you see this free cash flow going on, and especially this bit about 5.2 thereafter, which valuation technique must be jumping up in your minds right now as you read that? Come on. That's specific information for one of the valuation techniques. And it's similar to what we did last night. Right, free cash flow, dividend capacity, that type of thing, right? So again, both of those effectively model which model comes back into the calculation effectively? 3 letters, starting with D. So that discounting of these cash flows, that's right, the DVM. So it's a DVM process because we have the growth and so on, but it's just the numbers that we'll put in. We wouldn't call the number the dividend. We'll call the number the free cash flow. We wouldn't call R just a discount rate. The R now is the cost of capital, the KE. Good. So that's the substitutes into the DVM model, but the model works exactly the same as the DVM. So that should be jumping up in our minds to calculate the value of N shortly, but we'll need to find the free cash flow and so on. So let's keep reading. At present, 10% of B's. So we have all that information, 5 and 6 about N. Then we have some information about B, with that 10% of the PBT. And then there's some secured 10% bond taken over by N. Funds raised from the disposal of C would be used to pay off Tory's other non-current and current liabilities. I think that's where I want to go next. So I want to look at the next easiest item, which isn't so bad. It seems to be C. It's estimated that for Department C, the realizable of its non-current assets is 100% of their book value. So they actually give an easy note at the top. But its current assets realizable is only 90%. Costs relating to closing, Department C will relate with 3. And then we'll also have to pay off non-current or the other non-current and current liabilities. So go ahead, somebody start working what these two notes combined together would give me. So these two notes together, 1 and 2. You have to pull these together now and compute value gained from selling C. Right, so that's where I'm going next. So I'm trying to choose the sequence of easiness. So which may not be most easy, but seems to be okay. So I started off at the bottom where there was some fairly easy notes. I'm jumping up to the top now to deal with 2 other easy notes. How will we use this? The value afterwards is the cash value gained from the sale of C. So we could start off with putting that into a narration. Cash value gained from sale of C. So this is what we're looking at now. So we did A and B already. VNA, sorry. And we have sale of, what was the first thing? Non-current assets. Yeah, sale of non-current assets. How much is that? So this is a share of non-current assets as well. So the share of non-current assets here, we're looking for C, and we have it firstly as 20%. Right, so non-current assets is which line? Could somebody tell me non-current assets? Are we going to multiply by this 20? That's right, 98.2, this line here. Good. So NCA 20%. That's also the share of the current assets. We'll deal with that after. So one by one, lining them up. For sale of NCA equals 20% times, hold on, what's that? 98% that Stacy is throwing at me there. Oh, 98.2 million. So then I don't need that 100 that you have next door. 20% times $98.2 million. That's all we need. All right, so that's gonna get me. $19.64. Right, so that's NCA. Sale of what do we call that? Current assets. This now in the note 2, we were told some funny information. Okay, not note 2 yet. Right here, second line. What the current assets realized was 90% of the book value, and that's that. Same split, same current line, same 20%. So we just need the current asset value. Current asset was 46.5. 46.5 by 9%. Come on, not so bad. So don't forget, still 20% share. So 20% times the $46.5 million times, you're only getting 90% of that. Right, of course, you can use decimals all the way through. 0.2 times that, 8.37, very good. And what else we get in? So back to the notes. If that's what we're getting from selling it, the costs related to closing we have to put in, and then note 2 is telling us we have to pay off other non-current assets. Yeah, so we have to minus the 3, definitely, and then other non-current assets and current liabilities. So share of current and non-current assets are up here. Share of current, non-current assets, and okay. So I was looking to see what share of that we are paying off, but are we paying off a share after we deal with the 3? Yeah, I have the 3 right there. After we deal with the 3 and selling costs, are we paying off a share of this 20.2? Very good. Everybody seen that from right here? So there's no sharing. We are paying off the whole of the t values. Okay? So that is the whole 20.2 plus the 3. So that 3 plus that 20.2. And that's where we're going. Punch that in. So again, less. All right, 9:14. Our 10 minutes warning is up, and hopefully one more session and we will be complete. Less redundancy, if we call it that. Or closing course, whatever you call it. -3. Put some decimals in here. And then let's implement of TCO's other liabilities minus 20.2. Right, and that's a total of everything coming from C, and therefore that should tally us up to some value here. 4.81. Right, so we have two values in the back. So let's see, we got the combined A and A and V, and now the only thing remaining to do is nudge. So let's nudge off this nudge. We have to do, as we mentioned when we were reading the notes, free cash flow valuation model. All right, so value of nudge, N-E-D-E-G-E. Wow, how do you pronounce these things? It will simply be NCO for me, right? NCO. So need to value NCO. So of course, a little narration is always wonderful. Value of NCO can be found from using the discounted FCFEs via the DVM model. I still call it DVM. Right. We are given the level of growth after how many years, we were told? After free cash flows after the first year, right? The first year free cash flows will grow by 20. So that will be again a deferred perpetuity, right? That we'll have to do, and we will deal with that. Good. Everybody following that? Level of constant growth after year 1. Thus, this will be discounted as a deferred perpetuity from year 2 onwards. That is after applying the perpetuity with growth discounting, we would need to discount again for 1 year to move. All right, I'll just leave that there. Is everybody okay with that explanation? So I don't want to go too much in writing. We wouldn't get to finish our computation. So it's a year 2 cash flow onwards. And when you discount year 2 onwards, it steps back 1 year into year 1. So therefore you have 1 more year to discount it for, right? And that's that. So the year 1 free cash flows and the T0 free cash flows is now where all of the work is going to come in, right? So first need to find the current level of free cash flows for an edge, for ENCO, and of course grow by 20% for first grow by 20% for year 1. Right, so free cash flows, where are we starting with that? Let me save here. So we have 3 minutes in this session before we start the new session. Come on, free cash flows. So we have this bond being taken over. We have 10% of B, EBIT coming from C. We have cost of capital. So that was what we'll be using for the discounting, 10%. Estimated first year of operation for free cash flow to firm will grow by 20% and 95.2. So we have that, but we need free cash flow. N. What's N? So N will be coming from department B, will be spun off into a new company called N. Right, so that's where Nedge is coming from. So Nedge is department B. Good. So paragraph 2 and getting the profit now. Thanks for those things. 40% of T will become B, share of profit before as well as pre-tax. So this is now who we're dealing with. B. So if we're starting with profits, and again, which profit? So this is the discussion I was having with Anita. What is this profit that we have? We have profits before tax. We have depreciation. We have interest. We have profits before depreciation, before interest, before tax. So which one you think we're going to start with here? And I have pre-tax PBDIT and after depreciation. So I have 2 votes for this 23. And I have 1 vote for this PBDIT. Stacey, explain why you chose PBDIT. Come on, Stacey. I presume she's typing, so we don't get an indicator while the typing is going on. 14.96. Less tax allowable depreciation attributable to Part C, 10%, 14.96. Note 6. Let's read Note 6. Note 6 says a rate applicable to that NEDG can claim